going to talk about some economic modeling I've done for a client who's building a blockchain-based asset exchange platform. And one of the questions they were interested in investigating was why this might be interesting to governments to adopt. So I kind of took a little bit broader perspective on the question and looked at some macroeconomic modeling methodologies that might apply to this question and modified them to try to reflect what role the asset exchange might have in the economy, and then looked at some results, looked at some other bits of theory that might be interesting. So I'm going to go over that now, and then hopefully we can kick the ideas around a bit more, because it's a very complex topic and there weren't a lot of really clear conclusions, so I think it'll lead to some interesting discussion. The alternative title is inspired by my feeling that we're kind of really early on in the process of figuring out how economies should work, and maybe there was a pre-modern iteration of economies that was built on kind of roughly speaking the boundaries were drawn differently back then, but what we would now think of as religious ideas, and then there was another modern iteration with kind of bureaucratic ideas, and now we're in this early beta stage of figuring out something better, and the precedents that we have are really burdened by a lot of pathologies, and we can really do a lot better. So right now the notable pathology is what we observe empirically is basically that debt periodically accumulates and crashes the whole system. So we can look at some empirical data that shows this, but this is the trajectory that we've just recently been through with the Great Moderation, where it looked like the economy had stabilized for a long time, but debt is slowly accumulating in the background, and then it kind of accelerates, and then there's a crash. So this is the relevant data. This is 1950 to the present. So this line is the debt to GDP ratio, and then these are the changes in debt in different sectors. And so this is the changes in debt are kind of periodic, but they're just slowly accumulating. And then right around here is the Great Moderation, where there was a spike, but it seems to have leveled off, and everyone thinks everything's peachy. But now it starts to accelerate around the turn of the millennium, and here's the aftermath of 2008, and it's come down a little, but it's still at kind of historically mostly unprecedented levels. So this may not be the end of this story, and in order to kind of try to see into the future of this kind of dynamic, we have to rely on the models, because the history hasn't been written yet, but the models aren't really very optimistic about this, as we'll see. So I think this is kind of the basic problem, and we can question whether this is the basic problem, which we'll kind of do, and then we can look at ways to kind of deal with this problem, since we can give away the punchline, this is the problem. And part of why this state of affairs has been able to continue the way it is, which is that the economic models that economists who advise policymakers use don't even acknowledge that this sort of behavior of a changing state leading to a kind of discontinuous event is even possible. They're equilibrium models, so they only deal by definition with small deviations around an equilibrium state, and they deal with those statistically, so they don't really have a notion of the economy evolving in any way, or it's macro states changing as time goes on, which is it's extremely unrealistic empirically, because it can't model one of the most notable things we want to know about, which is crashes, and also theoretically that's just clearly not a good assumption. So an alternative to this is a dynamical system model, which does have, as the name might suggest, dynamics. So it has state variables and it tracks the changes in those state variables, and a system of differential equations determines how the state of the system evolves. And this is a preview of one that I modified, and this is how this is a trajectory that it generates of like different sector shares of the income distribution of society. I'll say more about that later, but it is able to model what we see empirically, which is this kind of long period of apparent stability, which is small fluctuations that then like gradually grow larger, and then like everything kind of crashes to zero. And that is accompanied by the debt ratio growing eventually without bound, which is also suggestive of, or what we saw kind of suggested that.
What is the left graph? It's income shares? What is that?
Yeah, so this is the income share of the financial sector, this is the income share of the labor sector. There's a third one, which is capital, which its dynamics are less interesting, so plotted, but I'll say more about that later. And then this one is the ratio of debt to GDP in the model. So this is like the equivalent of that chart we saw a couple slides ago.
Why is the one on the left look kind of so, like a sinusoid?
Well, because it generates this periodic behavior within this envelope. So, I mean, why is it periodic? We could go into the differential equations, or we could just kind of talk about. I'm going to talk a little bit more about kind of qualitatively why. And then, as I mentioned, there was this question that the sponsor of the work was interested in, which is that, and I think we're all might have some interest in it, which is like, as we introduce these new technologies that are crypto-based, like, can we actually like fix what's wrong with the economy using them? Like, how should we approach that? And this has been a part of the discussion from pretty close to the very beginning. Some of Vitalik's earliest writings about what Ethereum should do is it should kind of like be used to implement like an identity system and like a basic income system, so that you would be kind of like distributing the economic gains of society more fairly, and then just kind of like a fairness argument for that. But here I wanted to kind of develop a case in terms of like the actual like dynamics of the economy, the stability of the economy. And relatedly, Steve Keen, who developed the dynamical systems model, had been advocating for the idea of rolling jubilee, which is basically like continual debt forgiveness, so that you can kind of like take that exploding debt and damp down its trajectory a little bit, and that you can implement that as like a basic income that is just restricted to paying off debts. And the third one, which is one that is kind of related to what would happen if, like crypto exchanges become mainstream and you can trade all kinds of assets that you couldn't trade before, and like more people get involved in trading it, is that if you are kind of like taking the gains that are just like restricted to the financial sector of the economy and sharing them more broadly. So that's a kind of newer idea, and I want to kind of see how it sits alongside these other ideas, and kind of see which one like actually addresses the problem. So I spoke about that. So that dynamical systems model was generating those periodic trajectories. I'll just speak briefly about like how that is constructed. I'll refer you to Keen's own writings for a little more in-depth take, but basically you start from just like the accounting definitions of these quantities. So you have the employment rate, which is the number of people with a job divided by the total population, the weighted share of output, which is like all wages paid divided by all the whole GDP, and then the debt to GDP ratio. Likewise, then you differentiate all of them, and you just observe that the derivative is positive if the numerator is positive for all of those things, and then you can work out a little more math, but clearly there's no really disputing these definitions. But then you kind of work out the implications of this, and you get this, which is it's a very complex system of. This is a system of differential equations expressed in the form of like a systems diagram. So this is actually what I used when I was studying control theory to build like controllers for vehicles and stuff like that. But it's basically like a flow chart of like what the mathematical relationships are, and this is like a different way of viewing a system of differential equations. And unfortunately, it's like really they're both complex and messy. This makes it a little more tractable to trace out cause and effect relationships, but also like it's just they're kind of like multiple places that things go, so it gets complicated. So I'm not going to really go into the details of this, but the things that we're paying attention to are the debt ratio, which you saw plotted before, and the shares that finance and labor have of the income. And then this is actually a plot of employment versus wages share, and this is interesting because it has this kind of like cyclic behavior that you can see, and you can like watch it diverge to zero here. To say a little bit more. So the reason capital isn't really interesting is because it's kind of got like this fairly fixed relationship to the rest of the economy, where like there will be a capital investment if the investment is profitable. So like as the rest of the economy changes, like either there's enough demand or not enough demand for the products of capital, which is kind of like determined by how well labor is doing. So you get a period where like there's enough demand, and then you see more investment in capital, and then debt can be taken on to drive that investment, so debt goes up, and then like it flips over to the other side, and then like now labor needs credit to buy things, and there's not enough demand, so you temporarily have less investment in capital, and then like debt goes to labor, but like and both sides of that cycle, like capital's kind of in the middle with a fairly fixed proportion of the action, and then like finance is oscillating with labor, but like eventually it starts to diverge into this regime where like finance gets more and more, and then like the rest of the economy collapses. So that's the kind of pattern you see just in the baseline model.
I have a quick question on that.
Yeah.
That spiral graph there?
Yeah.
What's that kind of like wall that's not going over on like that horizontal line that like it spirals further down and down and down, but never goes above that line?
Oh yeah, well this is 100% employment, so
Okay.
you can't have more than that.
Okay.
And then what's over here to the right? Yeah, that's also like, that's interesting.
Is it starting with 100% employment then? You said it diverges to 0.
I think the initial condition is like somewhere right in the middle here, so like I think it's like this, the simulation is initialized with like a plausible, like empirically observed employment rate of like 90% or something. Yeah. So then I modified it by this also isn't very easy to read, but I'll just explain it what's going on. So I added a parameter that lets labor can kind of instantaneously buy a fraction of finance's income from finance, and like instantaneously gain the rewards that finance would be getting from it. So it's kind of like a like instantaneous version of labor getting to invest in a financial asset and then like immediately getting the returns of it. So an obvious shortcoming of it is that there's no like buying and holding of assets, but this was kind of like the first cut towards like modeling this question of like what if you had broader participation in financial markets that was enabled by like these blockchain-based financialization and asset exchange platforms. So basically that's just like this parameter between 0 and 1 that like lets labor exchange some of its gains for finances. I looked at that, I ran the simulation. Yeah, so as I mentioned, this was kind of motivated by the platform that my sponsor was building to financialize different types of assets like art and real estate and let more people invest in them. So I ran the simulations and I tested a whole range of parameters just to see if there was some sort of a regime where this made a big difference. the short answer is that none of them kind of fix what's wrong with the economy and stabilize it. I went all the way from like 1% to 80%. So here's kind of like a representative one, which is 10% sharing. So it does kind of like, some of them would damp out the oscillations over more of the kind of oscillatory period. But they tended to make the crash come a little bit sooner, and some of them kind of made it look more stable in the interim, and some of them made it less stable. So like 10% made it a bit less stable. In all cases, you see the debt skyrocketing because, like, kind of as I mentioned before, this doesn't really address the fundamental issue, which is that, like, on both sides of this business cycle, you have the accumulation of debt. And then there was an interesting special case of this, which is that, like, if you have 50% sharing of the financial income, then, like, you've kind of collapsed the two sectors into one. Like, they behave, you know, they see identical incomes. So that was like an interesting kind of like a corner case to investigate. And even there, where like you've kind of completely eliminated the distinction between finance and labor, and you see that in the income share plot. You know, it's the same line, so they are superimposed on one another. The oscillations are like very, 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 very tight, and then the crash is very, very abrupt, but you know, it still crashes. And you go through a lot more cycles in here, and you still crash, and you know, debt still explodes, and it still happens right around like the 160th epoch, like it did before. So it seems like, you know, regardless of what position you are in this cycle, like you're accumulating debt at pretty much the same rate, and that's what's killing you. So, and as I mentioned, you know, there's no buying and holding of assets in this one. So, you know, to try to model that, we can introduce like an integrator and some dynamics around like how much assets the labor folks are holding, and you know, give them like a trading strategy. It gets a lot more complex, but given that, you know, it seems like the accumulation of debt is the real issue here, I didn't move on to doing that yet. It still might be interesting to do. So you know, debt always blows up, and it blows up the rest of the economy with it. And this is consonant with what, you know, Steve Keen is saying about the rolling jubilee. Is kind of consonant with David Graeber's thesis in his debt book, where he's talking a lot about how, you know, ancient cultures have long recognized that you have to clear the debt out of the system periodically, or it takes down the whole economy. So the economic model has kind of shown that there's, you have to look elsewhere, you know, other than just like broadening participation in the financial economy to actually like fix the economy. You know, just like sharing those gains isn't really going to address the issue. So I kind of started to look at some broader views on this topic. So one that I found interesting is like the econophysics perspective, where the kind of seminal paper there was about wealth condensation in a model of the economy that was made by Franco and Mazard, and they kind of make like this thermodynamic model of the economy that's kind of like an ideal gas, where like transactions are modeled as like particles bumping into each other and exchanging energy, and you know, the amount that they exchange follows like a distribution that's a function of their two energies. And then the velocity of money circulation is kind of like the frequency of these collisions, which is related to the temperature-like quantity in this. And they investigated the behavior of that with different economic parameters. So they observed that if you have a higher velocity of circulation, you have less wealth concentration. There's kind of more diffusion of you know, wealth around, so you get like a flatter distribution. Constraining the transactions in any way, whether you know, limit these interactions to certain subsets of the actors, or you constrain their amount, or any of these things, they lead to more concentration as well. And they also identify like some qualitative regimes in dynamics of this model where you can kind of like, the titular wealth condensation is this regime where you kind of have these like winner-take-all economic dynamics, which are very similar to what we see where, empirically we might suspect that they're driven by this accumulation of debt that makes the finance sector more and more prominent, where you have these like winner-take-all dynamics in the economy, and you end up with like a small, constant-sized subset of the actors that have like a large, fixed proportion of all the economic activity. But if you change the parameters and you put them more to the parameters that have to do with the left-hand side of these, it can actually get like a competitive market dynamics where you preserve like a more uniform distribution of wealth and like a kind of non-degenerate market where like many exchanges continue to happen among many participants. And then another view on this is from Bernard Lietaer, who's one of the economists I think is the most interesting ones out there. He has long advocated for negative interest rate currencies, and that's kind of like related to this point because like if you have a negative interest rate on money, real interest rate, you can achieve that through many mechanisms. But it basically makes the time value of holding money negative, so you are looking to invest it in some other like productive asset instead of holding it in the liquid form. And this reflects like this tension between the store of value and medium of exchange roles of money, and this is kind of choosing to optimize for medium of exchange, raising the velocity of circulation. This also generates, if you're kind of like taxing the holding of money, this generates some proceeds from that tax. So you could use this to fund something like a basic income or rolling debt jubilee. In the historic examples where this was implemented, they used it for something similar but not exactly the same, which was like public works spending. So it was used in like a mining town in the Great Depression that was like suffering horribly, and they implemented this local currency that had like a mechanism where you had to put a stamp on the money every week that was like worth 1% of its value or something to keep it valid, and this in effect was like this tax on the holding of the money. And then they first of all people started spending money again very vigorously and made the local economy better that way, and then they also had all this money and they used it to build a bridge or something, like they were repairing their roads and people were paying their taxes early, and it was crazy, so on the local level this works, and there's more interesting history there. Like there was a bill that was in the U.S. Congress sponsored by like a fairly high profile Senator Bankhead, ironic name. So this almost became like national U.S. policy during the Great Depression, which said like support localities running these types of programs. And this was backed by Irving Fisher, who was an economist who was like a big, kind of like notoriously wrong optimist about the stock market in the 20s, and he was ruined in the crash, and like he kind of repented and was like, oh, that wasn't such a good idea. We should try to fix that. And he was really optimistic about fixing it this way. But then, like the people who were kind of involved in the Federal Reserve System said like, no, we need to do like a top-down solution instead, because this will like decentralize economic decision making, and like that's no good. So it ended up kind of like dying like a lesson. So as I was saying, like when you increase the velocity of circulation, you are kind of changing the structural incentives around people transacting with each other, and this actually is related to your like investment time horizons, it turns out. So Lietaer observes in the book of the kind of like monograph of this title that if you have this like positive interest rate, basically like you have this incentive to take anything that doesn't yield as much over time as that rate, and like turn it into money. So, you know, and like, you know, compound interest is very hard to beat, so like you have this structural incentive to like financialize everything in the economy. And we see a lot of that where, you know, we have like derivatives piled on top of derivatives right now, and like you know, you're like pillaging just about every other form of value in the world to like create financial assets out of them. But if you had the opposite, then you would be doing the opposite thing, because you'd have the opposite structural incentive, and you would be trying to take your money and create things in the actual economy that yield value over the long term, so that you could get that flow over the long term. And this is like another really like significant aspect of what's going on that kind of like very conveniently aligns with like these other perspectives on what you should do, which is that, you know, you should like find some way to forgive debts, and you should, you know, stabilize the economy, and like interestingly enough, all of these different perspectives kind of align. And so I want to sum it up in this way. So basically, like what we're used to over the last 500 years, the kind of like governments running a financial economy and a banking system, like they're basically doing everything wrong, because this is how they centralize things, but like by doing that, they also kind of like wreck how the economy functions. Like they really turn it into like a kind of approximation of a palace economy that is extremely inefficient and like structurally unstable. So if we're looking at like what blockchain-based platforms should do, I think like a good set of heuristics to use is to just like say like we should build ones that do the opposite, because that will make them like really pro-social and will give them a good opportunity to like thrive and fulfill like a good, you know, social role. So let me kind of like summarize what I think are the main aspects of that. Like the wrong things are to like tax transactions, because that's like creating friction on the, you know, diffusion of wealth and on the efficient allocation of resources in efficient markets. So, you know, prominent examples of those, income tax and sales taxes, and like I think a reason that those kind of end up being defaulted to is that like transactions are like the visible, legible things. They're the things that it's like kind of easy to keep track of and make people keep track of. So like this is like, you know, the like James C. Scott legibility bias here is very unfortunate, because it like creates the exact economically wrong thing. So I don't know if you were at Sonia Mann's talk, but she was also talking about you know, James C. Scott's thesis of legibility. But I think this is a perfect example of how that creates like these perverse incentives. So the opposite thing, you know, that money tax was one example of the opposite thing. Is kind of like the inverse of a sales tax, where like you're taxed for not spending your money instead of spending your money, or, you know, the opposite of like an income tax could be like land value tax or some sort of an asset tax, and that, you know, lets you gives you the opposite set of incentives, which is in the previous sense is the right set of incentives. You know, another thing that states tend to do is they tend to prop up monopolies. So they create, you know, intellectual property regimes, and they create like regulatory regimes for different areas of commerce and professions that like limit the supply of a lot of things, like create barriers to entry for people like participating in markets on both sides. And as we saw in like the econophysics work, that actually like reduces the kind of efficiency of markets and the extent to which wealth is going to diffuse in them, and it creates more concentration of wealth. So, you know, we should try to do the opposite of that. And there's, you know, kind of like a shorthand for a set of ideas that deals with like the pragmatics of how you do that, which is like free market anti-capitalism, which is this kind of like left libertarian philosophy of like having, you know, like free market mechanisms, but not having like structural privileges for like large entities like corporations, like kind of taking away the things that like privilege the large entities right now and crowd out the small ones, so that you'll have a free market of like small mutualist associations instead of like big top-down bureaucracies. And another thing that happens is you have this kind of like these narrow patterns of spending. So again, as we saw, like if you have a lot of constraints on how money is spent, then you have a lot of concentration of wealth and inefficiencies. So like in just about every form of government, you know, be it democratic or autocratic, you have a highly politicized spending pattern by the government, and there's a lot of like support given away to cronies, and that always happens along kind of these narrow channels of like political relationships. And so the opposite of that would kind of be like having this basic income mechanism or this like rolling jubilee mechanism that is always kind of like distributing the wealth that is taken in very uniformly without any kind of like design or prejudice behind it. And like there's another slogan for that, which is the title of a book that was called Just Give Money to the Poor, and that was what they found. They investigated like different forms of aid to you know, disenfranchised parts of the world, and they found that like by far the most effective thing wasn't to try to like, you know, fix this or that problem for them with a specific program, because really that would just end up going into overhead and waste and not help people very much. But like the thing that really just by far was the best at helping people was to just like give them money and like letting them make their own decisions to fix their situations. And then, yes.
Can you pause that for a moment?
Yeah.
You made a comment about rolling jubilee and how that might be funded.
Yeah.
How do you imagine that you elaborate on that?
I will in a moment. So yeah, so the last 2 points very quickly. There's this heavy focus on financialization of the economy, and you know, like right now we have a situation where like over 99% or something of global trade is in like financial assets and not in the actual real economy, and like all policies that concentrate wealth synergize very much with that kind of allocation of financial activity. So you know, there should be kind of a skepticism, I think, around derivative assets, and like a skepticism around claims that they are succeeding because they make the real economy more efficient, because like with, you know, the way that money is created through credit, like, and the fact that speculative dynamics exists, that need not be the case. So like this is kind of like the second plus point, and then the last one is like related to all these other ones, which is just that you know, when you have all of these constraints, you end up with inefficient markets, and then that in turn like exacerbates the original problem of concentration of wealth more. So like you need to have like a focus on efficient markets, which means like kind of broad participation among approximate equals, so that you actually have like, you know, the wisdom of crowd supplying and not like some degenerate situation. Okay, now then, so how do you fund this sort of thing? So one mechanism that I mentioned was that you have like the well, whatever your system is, it's going to have some form of like taxation, let's say. So one thing that people did was they took that and decided to spend it, you know, on public goods instead of like political crony rewards. So like I think the basic income is basically like a public good that you're gonna choose to spend your whatever the kind of like proceeds of your economic system are. Yeah.
So you mentioned perverse incentives and moral hazards, but don't you think that same kind of thing would apply if there were a rolling jubilee? I could just see so many ways for someone to effectively exploit that system. And I get you're saying it's broadly distributed, so it's going to these people, but corporations are really good at manipulating people.
Yeah. Well, something I think I also am in favor of is like just like tearing down the legal structure of corporations. But that's like a little more utopian. But like I don't think that's like a legitimate form of organization, personally, for other reasons. But like, you know, as you mentioned, like they kind of have these like pathological drives to manipulate people, and like their incentive structures are all wrong, so.
It's liability.
Yeah, that's one of them, like, I mean, like, fiduciary duty combined with limited liability and all this, so that like, you know, they don't, they're like forced into like this like antisocial pattern, right? Like, they're protected from the consequences of it, and like, they're actually like legally obligated to pursue it, so like, that's like a perfect storm of shit, so like, that's why I think like, you know, if you had a framework for collaboration that was the one that the state recognized that was like the opposite of that, that would really make a lot more sense.
At the same time, would we be trying to manipulate people's behavior with things like negative interest rates and stuff? Like, is it, like, this is
Well-
still manipulating people's behaviors like corporations do.
Well, it's more like.
It's a structural incentive.
Right, exactly. He's setting up incentives, right? So he's not manipulating you. It's, one of the interesting thing about blockchain is that we're sort of engineering these things up front, right? We're thinking about, you know, one example on his slide was that I found interesting, is there's been some other talks on, is if the things that we're building are really going to become the kind of, you know, economic substrate of the world, one question is, how do you pay for consensus, right? And your choices right now are transaction fees or inflation. Like, that's, you know, kind of these are the choices that different blockchains are making as they're being implemented. And so Bitcoin, as an example, has said, yes, you know, it's going to be with inflation up to a point, and then it stops, and then on some transaction fees. You know, transaction fees may not be the right choice, right? Inflation is basically a tax on accounts, right? Is maybe, you know, a better way to go, given these kinds of structures and how economies react long term to them. So if you set up these, you know, the rolling jubilee thing sounds, you know, to a kind of capitalist, you immediately say wrong because you're interfering with existing contracts and all that. That's all true, but we're talking kind of now about de novo setting up these systems, right, with incentives. So nobody's going to be surprised when they're rolling. It's not going to be like we pull the rug out from under everybody that's loaned money, and like we're talking about like setting it up from the beginning to work this way, so everybody will understand. Here's how the debt system is going to work, right?
Yeah, I mean, the mechanism of rolling jubilee actually does pay back the debts. It just like, you know, allocates public, in some sense, public funds to doing that, but like, you know, like the creditors get their money back. Like,
Right.
So who gets paid? The creditor gets paid directly, and then the debtor just, they're free and clear at that
They're
point?
released from.
well, like, so
There's
the idea.
a long history of this too, right? I didn't
Yeah.
finish Graeber's book, but you've mentioned it. Maybe you could explain what he describes as the history of these jubilees, and it's not like a new idea.
Oh yeah, well, like he points to the ancient Near Eastern kingship traditions incorporated the forgiveness of all debts when a new king ascended the throne, and like it's an interesting point. I think that like the formula that like Jesus is recorded as reciting on the Sermon on the Mount is actually like the formula that was used to introduce a new king and like forgive the debts, like, you know, in a very temporal sense. So like one way to read that story is like, you know, someone like getting up on a mountain and advocating an economic revolution. But you know, that was already, that had been an established tradition for like 800 years by that time already. Because I think they had already seen in, you know, like these early agrarian empires that like when you have debt institutions, like they're unstable and they like, take down society, so like they need to have some way of like relieving that pressure. Yeah, so there was like this culturally viable way of doing it, which is like, well, you know, there's a new king and like the world is made anew, and you know, like,
Especially the compound interest,
yeah,
which is like a mechanism in slavery.
yeah,
In the context of like when you're going down,
yeah,
like
and
amplifies your
I recommend this book.
peerage.
Yeah, because like kind of like what you're saying, like Graeber goes through a lot more of the details of this, of how like these institutions of like debt that are internal to a society often originate with like one society conquering another, and then kind of like imposing these obligations of debt on the conquered people, and then like as they, you know, the generations pass and they kind of like integrate more, like, they still have these unequal relationships that originated in like one war band, you know, like conquering another one, but now it's just kind of like internal to whatever the mess that, you know, came out of that integration was. And like people forget that like,
Germany,
yeah,
Germany, World War I, we imposed the dead version of Hitler.
So question on the, I mean, this is great, this is like really practical for designing a lot of these blockchain projects. The blockchain project I'm working with, I don't know that there's anywhere for someone to accumulate debt within the system. Like maybe that would apply to other blockchain systems or maybe at a higher level. But then we do have like a transaction fee to fund like a sort of common governing body in which everyone can participate. But, so, I mean, it sounds to me like that part of your talk is, I mean, it's certainly related to the debt part, but also standalone, like a standalone piece of advice. Like, maybe you don't want to do that so that you encourage, again, faster transactions and other sorts of economic transactions. You know, I guess you might advocate, as you said, taxing, say, money holdings or inflation was mentioned. Is that what? Does that sound right? And how do you see this applying both to individual blockchain projects and then like to the sort of group of blockchain projects as they become more important in society at large? Does that make sense?
yeah, well, like, you know, the obvious part is like what I was talking about, what you're talking about now, which is like, however, you know, like whatever the patterns of like moving money around that are structural, I think they should tend toward uniformity instead of towards like concentration. And then the other thing is like, that I mentioned on an early slide, which is like, you kind of have to solve the Sybil attack problem in order to do that at scale. And I think that is still a tricky one. It's kind of like tied up with identity and all these other thorny issues in these technologies. Is like, you know, when you have like a tendency to distribute wealth uniformly, you are now open to kind of like free riders coming along, and like the more kind of like frictionless and scalable your system, the bigger its attack surface is for that. So you actually start to have to like engineer a system that is more comprehensive in the scope of the things that it addresses. And if you go back to like, you know, the stuff that people were writing in the 90s, they were like very conscious of this, like, you know, like these architectures had, you know, identity solutions and stuff, and like it was really fundamental to what was going on. And like I think it still is if you're actually gonna like change how things work. And that's not something that I've seen people pay a huge amount of attention to in the last, you know, 5 or 10 years, when you just have like booming tokens and stuff, and like it's not important anymore to how you were gonna like make your money tomorrow. But I think it is really important to how this is gonna remain relevant for another 5 or 10 years, and eventually going to like take over and become the default. Because like, it's just like a penny stock pump and dump machine. Like that's not really. I mean, we already have that, but that's what we've been doing for the last 500 years. So,
Can you elaborate what you mean by identity in this context? You talking about identity like on-chain identity, like your private key associated, or private?
well, yeah, kind of like making it sticky and expensive, so that you can't do a Sybil attack by just like, you know, I'm going to create, you know, like all I have to do is like make a key pair, like you can do, and then go claim your share of the basic income, right? Like you have to do better than that. Like it has to be like, you know, there has to be some kind of probably a governance structure that is tied up with some kind of reputation mechanism to make sure that you've, you know, participated in good faith and that you're a real person for a while, and you know, then you kind of get in, you know, then you get your cut. And this is a lot of how like co-ops kind of face the same problem. So they've set a lot of precedents I think would be useful here, where like, you know, a worker-owned co-op is kind of like a similar thing, where like it's a very horizontal governance structure, and like you get entitled to the dividends and business and stuff by joining it. So there's like, you can't just have like any asshole walk in off the street and like take your money and screw up your governance, or else your co-op isn't gonna last very long. So you have to like vet them. So there's like a vetting procedure of like, you know, you have to work for 6 months or something, and like 2 people have to vouch for you. So it's still pretty simple stuff. Like once you see it, it's like very kind of obvious, but you know, I think we just have to kind of start paying attention to this sort of thing.
Do you think that once you increase the scope of the assets that you can start to financialize, via crypto, that the need for debt reduces. You don't need to get a loan now that you can actually buy it on an exchange.
Well, I think if you're financializing an asset, you're kind of like creating a lot about this, like, you're kind of creating like a liability that's backed by something, right? So in a way, you're like, to me, it seems like you're kind of changing what the basis of the debt is in a way that makes things more stable, because it ties it more directly to like things that have real economic value as opposed to just like speculative value. But like, that's a subtle point. I mean, what did you have in mind?
That's a tough question. I think on the surface it probably does. You wouldn't have to go out and, if you're able to trade your house easily, you wouldn't have to go out and get a loan for your mortgage.
Oh, just to like provide liquidity,
Yeah.
you mean?
Yeah.
And you're assuming resources to start with.
Yeah. Well, you don't increase the asset. Right. Or maybe it reduces the amount of leverage in the system.
You can't really engineer away debt out of the system. I mean, you can, but like,
Yeah, not after the
it's
fact.
not like the blockchain thing would somehow like prevent the need for people's desire for credit. These are contracts, right? People personally prepare to offer credit contracts.
Well, if the rolling jubilee is standard, and I know that every year I'm gonna get $20,000 or something, that would be nice, of debts paid off, then is the idea just to incentivize people to spend more money and have more transactions, or are you actually trying to take debt fully out of the system? Because wouldn't I then just do however much debt I would have taken on plus 20,000, knowing that that's my yearly allotment?
I still haven't run that simulation. But like, I think here's what I think is the point, is that like, regardless of the kind of like micro level incentives, there's like this macro level situation of like needing the overall debt level to remain under control. And like, as the overall debt level increases, it kind of like creates these structural distortions that like undermine the efficiency of markets and eventually crash the whole economy. And like, you need to prevent that somehow. And like, yes, that is going to create different micro incentives that might seem questionable, but I think like, I'm not sure that those are really a problem of any kind, even though like intuitively they seem like really different from what we're used to. And like, I know that at the macro level, like the alternative is unworkable. I think once you've paid off everyone's debts, then it kind of becomes, as you said, like kind of equivalent to a basic income, in that like, it's kind of similar to getting cash up front, is that like, if you know you're gonna have a debt allowance, you go and borrow it and then like, get it paid off. But like, there's nothing really, I don't think there's anything wrong with that, because like having everyone participate in the economy and like adding their little increment of like demand to like the kind of like social demand function is like adding information to the economy that's valuable, and like that's where you're getting like an efficient market from, is like this broad participation.
I mean, the idea of getting rid of debt out of systems is very abstract in general, because entire economies work through debt. At a very basic level, even if you're not taking loans, like, it basically means you have an obligation to go and do something. Like, that obligation resides like within your body. It's like, if I just like sit back and don't do anything, I'm gonna die. I have a constant everyday need to like somehow replenish my So in a sense, you're constantly in debt to maintain yourself, in that very abstract sense. And then all these layers of debt we're talking about are like built on top of these. So the very ability to hold financial assets means that you have claims upon other people. And that by default implies debt relations. So like I guess when we talk about like engineering away debt, it's just like how do you get around sort of toxic forms of debt and create positive forms of debt, and at what scale?
Yeah.
Because you work with Bernadette, who does all this stuff around like mutual credit currencies and stuff like that, which are essentially debt-based currencies. Like, think about mutual credit systems, is that they limit the amount of debt that can be issued to, they kind of like take a group of people and they say, what is like the maximum amount of debt that this group could like handle? So you can only get to a certain amount of indebtedness within that circle. And then like, if you want to like boost economic growth, you can then add new layers of debt on top of that, and that's when you really start to like get big.
The problem is the unproductive debt, right? You want productive debt, and you want to eliminate the unproductive debt.
Yeah, so you have a lot that just goes into fueling speculation, basically, right? In some form or another.
You're pulling wealth from the future into the present. There's only
You also
so
want
much-
to short circuit the feedback loop that causes the crash. Right? That's, you want to diffuse, like, that pressure builds until it finally crashes the economy over and over again. How do you put up some kind of safety valve on debt so that you short circuit that and somehow returns to a healthier state, faster or avoid it altogether, whatever the improvement is. We need something. Right?
Some people like debt fueled growth. Though.
Yeah.
It's like cool, get everyone in debt, build a bunch of shit, have a jubilee, start again, do it again, and use that. It's like that, like rather than the idea that you want like this sort of. It's, I mean, I'm not advocating that, but it's like because debt question's very like.
And
like
On the scale of a human lifetime, like, this sucks, you know, like, you know.
Yeah, of
That
course,
means
of course,
like,
yeah,
you
yeah.
know, a significant portion of the population has its lives ruined, like, you know, whenever that happens.
No, absolutely. Well, I mean, if you have bankruptcy laws and stuff, like this is essentially like jubilee type structures, right?
Yeah, well, I mean, that
Almost
that's
all capitalists.
Yeah.
Yeah, sure. I'm just vaguely making a generic point that like the real like debts, it's really about the politics that surround who's in debt and on what terms. That really makes it, that's the real like question. It's not really like what
who can access the debt too, right? So many people can't access, they can't get credit.
Yeah.
well, they can get it at extremely punitive
High
costs.
rates, user rates.
So, dumb question, but when the economy's overheating, why don't you just do a jubilee every once in a while? Just take that out of.
Because who wants to take away the punch bowl in the middle of the park? It's the same problem the Fed already has.
It's the timing.
Oh, we're over accumulating debt and everyone thinks they're rich. We need to stop this. No, everyone thinks they're rich right now.
Yeah, so that's why I think like a continuous mechanism is really important so that there isn't like gamesmanship around like when to pull the trigger, you know?
Right.
So who's building this stuff?
Well, and I guess the one question I still have is this scalability thing. Could you start small scale? You say you build this stuff de novo, building some sort of blockchain. Like, if you're building a credit system that's going to consume itself at a known rate, how do you get people to buy into that until it's scalable enough to be valuable? Because everyone knows that this thing's upside down from most currencies that it's going, right?
Yeah, well, there are examples of the negative interest rate currencies, for instance, and like that actually, like a big driver of that was like the current holders' desire to be able to spend it somewhere. So they would like be very persuasive in like getting people to accept it because they really wanted to unload it. So you know, offer people like deals they couldn't refuse, like not in the wrong sense of things. And you know, like it's like a driver that I think is very similar to like its evil twin, which is like the Ponzi scheme driver of like, you want to suck more people in before it collapses. Like, this actually isn't going to collapse, but you still want to like you want to suck more people in before like your portion like runs out of money. But like the system as a whole doesn't collapse, it actually like thrives in the long term.
So, I just as a helpful comment, think about these like credit systems on these, a lot of blockchain communities right now think about it. There's two forms of debt you can get. Like, you either take existing money tokens and you give them to somebody else, and you write a contract on top of that. It says, I demand something back. Or alternatively, you just issue new money, like, which is what banks do. And the advantage of the latter system is you can have far more dynamism and flexibility than systems where you're having to like find the money before you can lend it. So like trade finance, for example, this like you need these types of systems that are dynamic and organic, that sort of can expand and contract and do all this stuff. And then with the banking sector, your problems with this book, you can use a very cool analysis there. It's like awesome. I mean, in the sort of like basic sense, it's like there's a feeling that the banking sector does not engage in that money creation process in a good way. And so the question is like, could crypto systems get past this idea of like you need the money first before you can lend it? Which is what all the sort of lending systems are. People think about it. Like that's like a bond.
Like banks don't do that right now.
Huh?
They sometimes look for some form of collateral, but like they do just kind of like create the money on it.
Yeah, sure. But like say like bond issuance is an example of just taking existing money and redistributing it somewhere else, like one bank account to another bank account with a contract on top. Like so, like there's no money creation in bond issuance, but there's money creation occurring when banks are issuing loans.
Yeah.
Yeah. So like the bank creation of money is like one form of debt, and then like bond issuance with investment banks do, that's like just like redistributing it around about the place. So like, I guess it could be interesting to see in crypto systems, what would a money creation system look like? Like a distributed, decentralized money creation system at more localized scales than that. So you could have that flexibility without the sort of toxic effects of what the banking sector does. Make sense? And that's kind of like, I know there's people trying to work on those systems in this very early days.
Excuse me guys, sorry, I hate to break up the conversation, it's going well, but we've got another session here at 2:30.